Good turnaround Tuesday, Warriors. How you doing, Brand, Paul, Ingmar, AJ? Everyone doing all right? Jamie, nice to meet you. Hi, Ryan. So why don't we start off with U.S. dollar yen? Good morning. A mini wick compared to this wick that we had at the beginning of the month. What do you think's behind these things here? I mean, we thought fat finger here. Is that
a bull rush candle?
I don't know what kind of candle still closes red. It closed red here.
Yeah.
So it's like a beach ball. But one of these days, it's not going to be a wick, right?
Yeah, well, we still haven't decided what the actual low is. There's several lows on this move. It came about Bloomberg releasing a sources piece. It rehashed that the Bank of Japan were considering raising their fiscal year 2023 CPI forecast to near 3%. We heard that on the 10th of October via Kyodo. But there was an addition to this one that they may raise their 2024 fiscal year forecast to or above 2%. It's currently 1.7. So that would be a significant move. And it would tell us that the Bank of Japan perhaps are not seeing inflation falling back as they expected, and it's more persistent. And that would pretty much mean they're expecting inflation above target, or at least at target, for the next 18 months. So, that's okay. Plus, you've got a lot of nervous longs, I think, still sitting there. Any hint of something happening in yen, and sellers are ready to, or buyers, longs are ready to hit the sell button as fast as they can.
Yeah. So yields are trying again. I don't know if that's part of it. It could be. So, we're still well off the double top highs, but trying. And yesterday kind of talked about that this could have been a failing rally in the dollar into last Friday. The eclipse, maybe, secondary high. Do you think we're going to take out this 105.5, and that would mean euro could trade above 620 again? Or is this or maybe this is it on a turnaround Tuesday?
Yeah, it's a coin toss, isn't it? We've got to see this retail sales. I think what happens after retail sales is going to be important. If we see the dollar go bid on good numbers, but it doesn't last, so we see euro dollar dip back, but it doesn't last, then I think we're going back through 106 pretty quickly, and then the dollar index is pulling back. But the dollar isn't following yields at the moment.
No, it isn't.
We're playing this risk trade again. There's a what is it, a four-way meeting being set up in the Middle East. All the big powers getting together, Saudis, US, that sort of thing, whoever. So, the market might be smelling that this situation in the Middle East isn't going to blow up into the big thing. Hopefully, isn't going to blow up into the big thing that the market's fearing. So that's going to see a repricing of risk coming into the market.
Okay, I don't see much risk being priced into the market except in gold. As S&P's challenged last week's highs yesterday, it's coming off a bit, but that was a pretty strong day yesterday. So I think we're getting close to the line in the sand, and the S&P's too, for the bear case to be working. I'll give it to 440, but that's about it. So,
another set of solid earnings as well, haven't we, this morning?
We had good earnings, right, by the banks.
Yeah. But it's following yields again, isn't it? Yields go up, stocks go down. But I'm wondering whether we get a little rally at the open on the back of the earnings numbers, and is that going to be a fade trade if yields are still going higher? I don't know. It's
because we have come off a little bit. It looks kind of could be vulnerable. Definitely if we get back under this moving average 43.30 or so, that opens a door for maybe a full blown retest or take out the lows. So I still think that that's going to happen. I hope they accomplish something with this emergency summit. If they do, yeah, then we're off to the races, and you got to say the Melta people have a good shot at being right. So we'll see. Kman, good morning. How are you?
Good morning, Dale. Good morning, everybody.
Any comment on cable being so much weaker than euro?
Well, yeah, we spoke about it this morning. Euro crosses have been behaving pretty well this morning, and sterling is one where euro sterling is looking pretty big. I've been showing the interest rate differentials, and they're moving a bit against sterling compared to euro for as well, and that may be the explainer. But needs to be said that in cable as such, we seem to find bids just below 121.5. You guys had that sharp drop down to close to 121 on Friday, right? But then since yesterday, moves under 121.5 seem to be bought. Now, is the market a bit too long dollars in the short term, living on a bit of hopium for this meeting tomorrow? It's possible, but if I look around, it seems the dollar is a little less buoyant than it was over the past days. So I don't know if the market's already too long dollars or so, and waiting for what's to happen. Of course, the Middle East situation can change everything, but yes, the sterling is weaker than the euro for sure. Yeah.
Okay. So, I mean, this looks to be kind of the line in the sand here in the dollar. Right?
Yeah, the retail sales can be a mover, right? Because we've had, let's say, better or more supportive dollar data out of the US compared to the others, although the zoo was a bit higher in Europe this morning, and that must have underpinned the euro crosses too. But yeah, those retail sales can change the picture a bit if the market is already a bit too long dollars.
Is this a big story, Kay?
I think it potentially can be, because they China are injecting liquidity, injecting money, trying to change banks. Interest
Are they going to let it go?
And stuff, and we are in this 732, 733 zone. If that goes, that means that we will be above the 2%, above the PBOC fixing. So, are we going to see some intervention, or the submarines being sent out? Possible, but we are in the zone. Interesting watch. If the retail sales are better in the US, then this thing could have a real test of the 733, and then possibly 735, 6 beyond.
Okay, so we've been talking about the breakdown in copper for a couple of weeks, which I associate China with. So if they're gonna, if we're gonna see new highs in USD1, you know what this reminds me of, actually, when I look at the copper chart? It reminds me a little bit of the TLT chart. So you see this low that we made here back in July. It's a confirmed low. And remember, the bear case for me in TLT was the confirmed low in October of last year right here. And that's why I didn't think that we would, that this was going to be the low, that we would take it out. See that? Doesn't that look similar? That copper, it had a little better rally than TLT, but it was still a confirmed low. Looks like this is the target. And, Dr. Copper is saying there's economic weakness because, everyone loved copper for a long time because of, people were collecting copper, and it's still pretty expensive compared to what I remember in the old days when it was like 80 cents and 70 cents. But I don't think this is a good signal for the economy.
But then if you look at it, the CNH is probably reacting more, or copper reacting more to the CNH than the Aussie. Aussie has decoupled from it, right? Well, at the moment anyway. That one is doing a bit better than what copper may tell us that it should do.
Yeah, it's a good valid point. A lot of people looking for 62.20, and we did not make a new low, did we? No, it held it. It held the low.
Bit of Aussie Kiwi, bit of reluctancy to be very long dollars, bit of RBA minutes, but yeah, I mean we're still not back above 64 and stuff like that in the Aussie dollar. But we have to note that it's decoupled from what could be one of the drivers, which is copper and China really.
Okay.
But we have to watch it on a different basis now for the time being, the Aussie.
Okay. And speaking about confirmed lows, even though we had after this, Blake, confirmed lows, that silver doesn't have as strong of a structure as the gold rally. I think gold's going to outperform, but down here you had a confirmed low.
Yeah,
so
your two lines there are important enough. I think 20 and anywhere close to 23, and then 23.20. If that goes, then we're going to shoot higher. But if it calms down, and for humanitarian reasons, let's hope so. But if it calms down in the Middle East, silver will probably underperform. Yeah.
Yeah. Well, if copper's bad, and silver is not just a monetary metal, but industrial, that's not bullish silver. So anyway, I know gold can rally with a strong dollar, but historically, you need a bear market in the dollar to have a bull market in silver. So
or very good economic data.
Well, yeah, I mean, I've seen charts. Every silver rally coincides with a dollar decline. So maybe it's different this time. Go ahead, Blake. I'm sorry.
No problem. And good morning, guys. I just wanted to mention, well, first of all, Dale, that's really good information from somebody that's been around for a while and has watched silver, for the last several decades. I mean, it's important to extract that type of information, especially for you viewers that haven't watched as much of the markets as somebody like Dale. Dale, I think that's a good statement. You don't see prolonged silver rallies without a sell-off in the dollar, and right now we're not seeing that, right? I think if there was a much bigger and broader US dollar move lower, which if you look at technically at the dollar, it looks like we're trying to forge some sort of longer term high. Yeah, I mean, and maybe the next down move that we see in the dollar back below 100, that's maybe the catalyst to drive silver back above 30. So
yeah, that would do it.
I mean, I actually think the dollar is forging some sort of longer term top. I just don't, but it's a hard call, especially at this point when you have so much happening geopolitically. I was thinking about what you were saying, Kman, earlier about the dollar and about positioning. I would think that positioning is probably at this point in time, I think you're right. Like you need more data to be a buyer of dollars, or you need to see things escalate in not that anybody wants to see, but in order to entice more people to buy dollars at this point, you're going to have to see things heat up a little bit in Israel and Gaza. And then the flip side is no one wants to really sell dollars either, because you don't want to be stuck with your shorts around your ankles if there is if the fighting does intensify and the rush to dollars comes. So I think that's kind of leaving the dollar at a stalemate right now. And that's also, we had this discussion yesterday on the Morning Edge, which the Morning Edge is it's our show that we do after F.A.C.E for the ForexAnalytix community. We talked a lot about yesterday target trading, which is basically finding the levels that you want to be involved at and only being involved there. Like I'll give you an example if you don't mind, Dale.
Oh, go ahead, grab it.
Okay. Like, we talk about a bunch of different markets. We don't talk about just, your currencies. Like for example, here is the pound Aussie, right? So the pound Aussie over the course of the last, week has been setting up this head and shoulder pattern. You can see it. And basically, we went right up to the shoulder and reversed yesterday following the RBA minutes that suggest that the RBA is actually still discussing, possibly raising rates again. And so as a result, you're seeing a move from levels that you would expect. Like, for example, if you look at the euro, euro has really key channel resistance now that comes in around the 106 level. You have a 618 retracement that comes in at 105.86. So yesterday we talked a lot about, don't get involved in the markets, where we're currently at, which happens to be in no man's land. If you want to be short the euro, short it above, 105.85, the 618 and maybe up to the trend line, and don't get involved with the market until you see it. And that's the safer way to play the markets at this point versus trying to momentum based strategy, because I know a lot of you, employ some sort of, EA, type of algorithm, automated system, and you're probably getting smashed, left and right because your momentum strategies aren't working right now. So it's important to understand what market you're in and how to employ certain strategies in certain markets. And that's a lot of the stuff that we talk about, on our shows on the side. Anyway, I just want to mention that because I could only imagine what's happening with a lot of people right now trying to chase the markets all over the place. There's one other thing I wanted to point out really quick, and I wanted to ask Ryan and Kman some of their opinions since they've been awake, longer than we have, Dale. One of the other charts I wanted to bring up is the dollar Swiss. You guys want to talk about where a little bit of a rush to safety is? It's in the Swiss franc, and I know I did a YouTube short last week saying the dollar Swiss would be a great short right here at 91, and we were trading here and we're looking for a bounce back to the neckline. That worked out pretty great. But what's more important is we're sustaining Swiss strength as we come to this trend line support. So if you look at today's retail sales number, it's hard to bet against the U.S. consumer. You hear me say that all the time. But in case, those numbers come in weak, especially, the core data, minus food and energy, you see that number coming below expectations. This dollar Swiss is going to, it's going to crack this 38% retracement. You can see it right here at 89.82. We go below that, you have a double top, but more importantly, I think the Swiss franc is being bought for a lot of other reasons other than just selling dollars. It's a safe haven currency, and you're seeing it. You can really see it in the Aussie Swiss. What had happened, since last week, since the Israeli situation intensified, but you can see it really there. You can see it in the Euro Swiss as well. You can see what happened there. So keep an eye on the Swiss franc. I think the Swissy is one of those that is not being watched all that much. And I think that when you're looking at the dollar Swiss, you can clearly see, what levels are in play. So let me ask Ryan. Ryan, that Bloomberg piece overnight, regarding the yen. I know you talked about it earlier. We've obviously had a lot of people shuffle in since you mentioned that right when we started. This push that we see here, I mean, how come there was such a reaction like that when I was reading your what you'd put in the chat room, and it clearly says, I mean, the article clearly says that that it's not something that we should really be thinking about. I mean, it says BOJ's stable 2% inflation goal isn't within sight yet. The people said the outlook for fiscal 2025 is likely to remain around the current forecast of 1.6%. I mean, what was in there that triggered this response?
Well, you got to question that article in the first instance, because I think for 2025, the current forecast is 1.8%. I'll have to double check. I did have it up earlier. It's twofold. Okay, we had that story about the fiscal year 2023 already. Last Tuesday, Kyoto dropped it, so that wasn't new. The new bit was pushing 2024 up to 2% or above 2%, which is a big. If it goes like 2.1, 2.2%, that's a 5 pip move over where it is now at 1.7%. So that is a big signal that they're not seeing inflation as weak as it was. They're seeing it more stubborn, and that's just another step to take closer to ending easing. But I think that the move in itself, I mean, we've got different lows all over the place, which shows you how messy it was on that wick. Reuters have got 149.24, Bloomberg 148.84, some of the retails 148.73. It's all over the place. And I think that's an indication that longs are still very nervous because of the potential from the Ministry of Finance. We were on the F.A.C.E show, and Kay was talking about something, and he's looking at dollar yen. It dropped 20 pips, and then it went, and we were wondering what's going on. So in that time where we were wondering what's going on, it flashed down to that low. There's people there who see a move in the yen and think, shit, what's happening? Is it the Ministry of Finance? And they're not going to ask questions. They're going to hit the sell button and worry about it after.
Right. And shoot first, ask questions later, right?
Yeah, it probably took us, 30, 40 seconds before we actually got the headline of what it was all about. I mean, we were kicking ourselves because, down there, 148, 70s, 80s on that headline. Well, me and Kay would have been smashing our own buttons to buy it, but we never got a chance. But yeah, I think there's still a lot of nerves about being long right now up at the top with the MOF intervention threat still hanging over us. So, it's going to bring moves like that. But yeah, if it happens, it's another shift from the Bank of Japan on top of all the other little shifts that they've been making, and they all add up.
All right. Well, Kay, do you think we should read into it too much? I mean, I know Ryan just gave his opinion here, but I mean, price action wise, I mean, this thing is just nestled up against 150. I mean, it's hard to be short the dollar yen, right? Kman?
Sorry, I just lost my internet connection for a couple of seconds. What was the question?
Welcome back.
Please? It's hard to be short?
Yeah, I was just saying, is there anything you wanted to add about the price action here in the dollar yen? And
no, I think it's just Bloomberg.
Sounds like we're losing Kman. Is it raining over there with you guys? There, Ryan?
No, sun's out, mate. He's doing his normal Collier impressions.
Sun's out, guns out, huh? Oh, well, yeah. You know what? Kman, we'll come back to you. Hopefully you get your internet squared away there. And so Dale, we had a lot of earnings today. We had earnings from Goldman Sachs. J&J is really, I would say J&J's beat right now is probably one of the things that's carrying the market as much as the market's being carried right now, because it's actually down. Most of the banks are flat. You see Johnson & Johnson pre-markets up just a little bit. We are in earnings season, and a lot of things are going to be watched. Like tomorrow, you got Tesla, you got Netflix, we got Morgan Stanley tomorrow. So a lot of big earnings this week. But looking at stocks, what do you think the stock market's waiting for, Dale?
I don't think it waits for no man. I think that
no man or no company, huh?
Yeah, no trader doesn't wait for anybody. So, I still think as long as we're under 44, say 40, there's still a chance we take out 4,200. I'm betting on that.
Well, we are trying to forge out a lower high, and that's the one thing that I think we need to watch. I've told everybody yesterday, your levels are very well defined right now this week, 4,400, 4,300, and this is your sandbox. So you little boys and girls, go sit and play in your sandbox and don't go out of your sandbox, because when you do, that's when, you know, things are gonna happen. You know, when we get out of this little sandbox here. So just be aware of your surroundings. And right now, I think 4,300 and 4,400 are going to be the levels to be watching for some sort of, you know, consolidation type of breakout. Hey, really quick, we have retail sales coming up. Obviously, I want to take a look. I just looked at the euro. You can see that clearly resistance comes in around the 105.80 to 106 level. 105.85 being the 618 retracement. Sterling, I think resistance is going to be this trend line resistance, which comes in around 123. You also have this resistance right here at 122.70. Huge support right now at 121. So this is a pretty clear, you know, 121 to 122.70, that gets my attention when you pop out of those ranges, because then it's a resumption of trend down to the downside here. And then obviously if we get above this trend line, then things get a little bit more spicy.
Was it you, Blake, who said, you know, you just stick to the levels, or was it Ryan of, you know, levels that you're looking to trade and everything in between, you just let it happen? Well, when it comes to the euro, that's exactly what I'm doing, waiting for a little bit over 102.
Yeah, Ryan
can do whatever it wants to do.
Ryan's really key on the levels, and I can't agree more when Ryan, you know, he harps. Ryan, you can go ahead and harp on stuff. Go ahead. I was going to harp for you and imitate you.
No, you go ahead, mate. You go. It's nice to hear someone else harping on my behalf.
No, Ryan always says it's all about your levels, and Paul Franco, Paulie, you know, he says the same thing in our community. He's on the daily roundup. You know, it is really, you got to find, especially in markets like right now, when everybody's kind of in a stalemate. It's almost like a Mexican standoff, and everybody's got their pistol drawn. You know, it's all about, you know, what level is going to break first. And so you've got to be pretty, you know, cognizant of that. Like I look at the Aussie is bid up today because the RBA talked about that they might raise rates, and it's outperforming. You can see the Aussie Kiwi. We bounced right off of triangle support, you know, last week. And, you know, we're ripping back towards the 50 DMA and 200 DMA because it's got, you know, weaker New Zealand inflation. And you've got the RBA that's still, you know, putzing around talking about possible rate hikes. So, you know, you got the Aussie though that's pushed right up into resistance, and we're right into this resistance zone. So key support, there's resistance. You're right in between. Leave it alone. You know, it's like, you know, everything is kind of mid range, and I think we really need some guidance from Katie what's happening.
From Katie Stockton.
Yes, from Katie Stockton, exactly, to see her views on the market for sure. You know, the dollar, and we're gonna keep an eye on the dollar index as we have retail sales coming up. Actually, you know what? Forget that. We have Canadian inflation data. We're gonna pull up the dollar CAD and keep an eye on this one. But the dollar CAD, you know, this is another really, you know, great example of a pair that is, you know, we completed a head and shoulder pattern. Now we're just kind of sideways, waiting for a possible breakout, or in this case, this would be, you know, your wedge bottom, which is near the 618 retracement. There's a wedge breakout or breakdown as we're near a long-term channel top. You can see a long-term channel top. Yeah. So I would just be focused on that right here. Resistance at 136.50, 60.
That's a big descending triangle there, Blake, that you just had in Canada.
It is. And we're going to keep an eye on the dollar CAD because we have retail sales in less than 1 minute. So we have U.S. retail sales. We have Canadian CPI. Ryan, any last minute thoughts here before that data comes out?
Any last words for your career?
I'm gonna pull up the data flash. Go ahead.
Yeah. Watch those yields. Always keep that 10-year yield on your screens at the moment. Just see what the dollar reaction is. You know, if it's going to take off on good numbers, it's got to hold it. If it doesn't hold it, well, then pairs like Aussie dollar, euro, cable might be in for some further upside.
Yeah, watch this. And this is the yields right over here. There's your 10-year. And then remember, we have the dollar CAD right here. And that data is coming out in less than 10 seconds. So heads up, everybody. Let's look for a reaction. Scream it out if you see it there, Ryan.
Yep, we'll do.
I'm not sure if Kman's still around. So
CPI soft in Canada.
Wow. Look at that.
Retail sales hot.
And retail sales is hot. Again, there you go. That's a double whammy right there for the dollar CAD. And that's, you can see we screamed right past that resistance at 136.50. So, you know, it was
there go the metals. And
yeah, we can pull up gold. Hold on, just let me delete this stuff really quick. You can see the dollar CAD is absolutely ripping. Like I said, nice little double whammy when you got weaker you know, CPI and then, you know, strong retail sales. Look at gold getting smashed. Guys, this is the problem with betting against the U.S. consumer. I remember I was at my 20-year high school reunion. I told this story before, but it's so funny. I'm in Phoenix, Arizona. I'm going to my 20-year reunion, and we're having the housing crisis in what, 2007, 2008, or whatever, or it was 2010. I'm sorry, it was 2010. It was, homes have been sliced in half. $1 million homes, 400,000, and people are in the malls jam-packed, and they're not even paying their mortgages. That is just exactly the U.S. consumer in a nutshell. They're like, well, I'm not paying the mortgage company, so now I have extra money to go buy a new iPhone. That is the American consumer in a nutshell. So it's hard to bet against that. All right, Dale, we got one of my favorite technicians here, Katie Stockton. I'm so excited to have her here. But I'm going to pass it over to you. Kman, I hope you get the internet sorted. Hope you're back.
I'm back.
Oh, okay. Good to have you back. All right. And Kman, Ryan, thank you guys for being here. And make sure you guys are tuned in to the Flow Show. Remember, every morning when Dale and I are sleeping, the Flow Show is happening. So if you're trading during European hours, you should be listening to these guys. They'll be walking you through what the hell is being reported at Bloomberg about the Bank of Japan and what they're thinking, and, you know, all that stuff. I love when I get up in the morning, I get into, you know, our community, and I've got Ryan, Kman, and the rest of the European traders that are in our community to kind of get me briefed on what's happening throughout the course of the day. Well, you guys should all be catching that live. All right, Dale, I'm going to pass it to you.
Thank you, team. Thank you, Kay, Ryan, Blake. Welcome back,
Thanks.
Katie.
Thanks, everybody.
Thanks, Dale.
How are you?
I'm good. Good morning.
Good morning to you, Katie. So last time we talked, you know, S&Ps were trading 43 something, and you were talking about I see 4,500, which was a good call. So we stretched it to 46, and I see you occasionally on other financial media, and you've been calling what's been happening since 4,600 a correction. You still stand by that?
Yeah, we do. You know, corrections often unfold in this ABC wave format. I'm not an Elliott wave follower, but it makes sense. And it's really how it's unfolded this time around. We don't have a selling climax or anything of that nature to suggest that the correction is fully over, but we do have upturns in our overbought, oversold metrics. So, you know, the weekly stochastics and, you know, the daily MACDs, we have enough of a shift in short-term momentum to suggest that it is over, even though we didn't get that big volatility spike or a selling climax. So we are sort of deferring to the cyclical bull trend as being intact, which is, as a technical analyst, I mean, that's what we should be doing, right? Just respecting the primary trends. But while we're bullish short term, and we have been for, I'd say, a week and a half or so.
Since 4,200 was a very obvious place for the battleground or for a correction to end.
Yeah.
And to me, it seems too obvious. I still think we have a shot for that selling climax, which you're talking about we didn't have.
Yeah, you're not alone in that. I'm sensing there's a lot of calls out there for even an 87 type of move. Here's hoping that's not the case. I know, you know, I think it's just that this time of year, right? Once we get into October, fears are often running high. It was the case last year, and it's the case again, but we're seeing those sentiment metrics, which did get oversold enough, right? We did get enough of a contrarian reading and things like the fear and greed index to suggest that we have some kind of low unfolding here. I think the real catch is that we don't know if this is just a short-term low or something that has more staying power. And in our research, we're suggesting that our long-term bias is still neutral unless we can see the S&P 500 get through that 4,600 level, which has proven to be a really strong level. And I don't mind that the 4,200 is so widely followed, nor do I mind that the 4,600 is widely followed as resistance. I think there's a reason for that. And, it makes sense from where it's peaked in the past. And for 4,200, there's really a confluence of support there.
Yeah, so that's where we became parabolic to the upside when we took it out. That's how we got to 46. So it was kind of natural, a natural. I did hear that you said for us to get the market going again, it would be nice if yields peaked. So that's also
it would be, wouldn't it?
Well, I want to see them go up. So I'd like to see a cleanse, but it doesn't look like they've peaked yet. We had a little bit of a pullback here on the 10-year yield, and TLT is trying to base, but it looks like we could still flush one more time.
Yeah. So, could I share my screen, Dale?
That'd be great. I'm so tired of looking at my charts.
They're good charts.
All right,
but I want to show you something specific, and it's based on the DeMark indicators on the 10-year Treasury yield. So if we look at 10-year yields, and hopefully this will pull up, I'll make the chart bigger that we're going to hone in on here. But on 10-year Treasury yields, we of course have this very steep up move. This is on a weekly bar chart.
Yeah.
And we saw a breakout, of course, above that 434 level. Now, if you look at the red arrows, so here we have one here, et cetera. They've really been very timely indications of the corrections, that have ensued within the context of what we believe to be a secular uptrend behind yields. And you can see that just in the cloud model, the shaded area. The market indicators, though, that are the source of those red arrows, they've been conducive to upside follow through up until this point. So I do think that we have enough of a counter trend indication that we should see consolidation at a very minimum, something like this, perhaps, right, where we have consolidation, sideways action for maybe 6-8 weeks from here, based on the nature of these signals. And
so you got that signal 2 weeks ago, Katie, where you have the 5 up there. Okay.
That's right. So it's actually the 9 that generates the red arrow, and it was preceded by a 13, which is very similar to the last two sort of pre-corrective signals. And those signals are indicative of a counter trend move in the nature of up to, I'd say, 9 weeks from where the 13 is generated. So we're already into it, theoretically, based on the DeMark indicators. So we would expect more of the same. And I think that that is key towards the relief rally in the equity market sustaining itself over that same time frame as well, which, as we know, is a very strong seasonal period for the equity market. If we go into any of our sort of seasonal work, I love the seasonal graph that I can try to pull up here.
September was a bad month, and through the end of the year, it's bullish.
That's right. So and it doesn't matter how we slice it. This is a 5-year view of the S&P 500 on a monthly basis, just returns. And you can see October, November, really very strong after a very weak September. I mean, we can go back 10 years and see the same. We can go back 20 years and see the same. So it's a fairly...
Can you go back 50?
Because
that was the last time we had a big war in the Middle East.
It looks like we can only go back 30. So
all right, I knew it, but this is something, and I feel this way. I've been talking about it, that this is a big deal, and it can overwhelm your charts. It can overwhelm seasonals. It's one of the biggest geo events, probably bigger than Ukraine.
For sure. Yeah, we have to respect the geopolitical drivers. And this is what I always tell people is that when we're looking at charts, we're sort of listening to the market. The market is trying to tell us something. And, all the information is getting boiled into the price trends, but we can't, predict why something will happen, right? We can only really, as technical analysts, react to it. We can try to manage risk with what we know. As an example, this is the weekly S&P 500 chart. We have this oversold condition here with an upturn. Historically, that's been a good entry point with a duration of at least several weeks, right? So that just puts probabilities in our favor. Now, Dale, there's so many risks out there. And if those risks do generate a breakdown, and for us, that would occur really below here. So sort of 2 weekly closes below here would be a pretty big setback in our opinion for the market. We would certainly manage risk through that and react to that. So what's nice about it is that we have an oversold reading near a strong support area between the 200-day and this former resistance. And then, we know where our risk increases. It's below that area because the next support, in part based on the cloud, you can see that's around 39.08. So there is,
that's my target for a swoosh if we get one, about 39.5, not quite the March lows. So that's interesting that you bring that up. So,
and look at the Fibonacci retracements here. So if we take the whole cyclical bull move, the 38.2% is at 41.81. So that's actually our bottom boundary of the support level that we've been highlighting. And when the 38.2% is taken out, then it sort of targets the 61.8% retracement. So that's also fairly well aligned with the cloud. So you can see the importance of this level and then secondarily this level. But the indicators do support a return to the highs, even potentially around 4,600. In the very sort of near term, there's a hurdle based on the daily cloud. If you see that here, that's at 44.71 on the daily chart. So that's going to be the first hurdle by our metrics. But we think that the momentum shift and also the breadth shift is strong enough to get us up to this resistance.
Okay, is the dollar also part of the play, like the yields where the dollar has come off recent highs? We put in a lower high in the Dixie on Friday, and up until the news, retail sales news, it was starting to decline again. So does this look like, I'm not an Elliottian either, but in ABC, that the first decline that we had was A, and what are we looking at, a weekly?
Yeah, perhaps. And this is the weekly bar. So I think the takeaway is maybe a little bit more muted than what we have from the DeMark indicators on treasury yields, but you can see here too, we have a red arrow. And that's based off this signal here, this 9. And you can see that it occurs within the context of the cloud. The cloud is really very reliable for FX. That's at least in our experience. So as an example, like when you see this downdraft here, the bottom boundary should provide support. And then when the upper boundary provides resistance, that's a setback, right? And here's your breakdown.
Where's the upper end of the cloud right now, Katie?
This is about, let's see, 107.78 for the dollar. Okay. So this is a longer term view. You can see the overbought reading here, of course, too. So not quite as decisive as what we're seeing in yields from our indicators, but you could certainly see some consolidation within this context. But back in here, this was a pretty meaningful breakout, right? It cleared so many resistance levels within this context here, the 200-day, the 50-day, the daily cloud, this previous resistance. So I think we have to trust that this is a real turnaround from a longer term perspective, and that what we're looking for is more just near term consolidation.
Okay. We had that explosion in gold. Some of the shares have acted good. Are you on the miners now? Do you believe this wake up call that gold gave us with that $110 rally?
I'm not a believer, and only because it was preceded by a breakdown, and there's still resistance. If we look at the generic contract, we have this cloud, which has been very reliable here too, of short-term peaks. And notice here we have, so the shaded area is the resistance very close by, runs up to about 1937. And if we break through it, well, then I'll be a believer. But you see what has happened in the last 3 up moves. It has failed right near that cloud. And also with the red arrows popping up at these 9s, you see that we're on an 8. So we're pretty close to an overbought indication there. So once we get through that, or if we get through that, then I'd feel better, like this downdraft is maturing. Yeah. But for now, I think we have to trust that it's still counter trend.
What was that 4 above it? Is that a DeMark number?
That's a DeMark number. Yeah, it's a little bit of sort of a funky way that it's developed in here. We look for 13s in that sequence, the purple one, and it's obviously pretty far gone.
So we're far away from 13s.
Yeah.
Oh, okay. So what else is top of mind for you, Katie, as we work through this week and you know what's happening geo-wise? Every time I see a move in the cannabis stocks, I think about you because you guys stopped covering them. Are you starting to cover them again?
Well, it's interesting. No, we haven't come back to them. But listen, like we're paying attention, right?
Yeah,
they have perked up, and we're kind of interested in almost like the macro takeaway there, because it shows a risk appetite, but it also could just really be specific to regulation there. So, but we're intrigued, and we're also, I want to show you a couple of things. The Russell 2000. Look at this trading range. I mean, it's
ugly.
It's ugly, but look, here's another one of these arrows. This is a green arrow at an oversold reading. So it tells us that we should see support discovery by the Russell, which is a small cap benchmark. And therein, we should also see breadth improve. And breadth is not great, or has not been great, as you know. In fact, it's really been an issue all year. We're kind of back to square one in terms of market breadth. The cumulative advanced decline line really needs to bounce here. That's what this is. You see it's got it's testing the cloud, if you will. So we really want to see breadth expansion. Or if we don't, then that to me will take away from the sustainability of this relief rally. And the last thing that we have on our radar is Bitcoin, which is something that we do still cover on a weekly basis. Arguably, it's been a bit boring lately, but it could get pretty interesting here, because we have, with the recent news around the ETF sort of possibility, we have a pending breakout in Bitcoin above our cloud. And just like for FX, the cloud has been really very reliable. Here it acted as resistance. Here we almost had the same type of action that you saw before in the dollar index, where it came down, it held that resistance, and here was your breakdown. So now with this, if we see a couple weeks above, so just this week and next, that would mark a pretty significant breakout in our work for Bitcoin. And it doesn't really resolve some issues on the monthly chart, but I think from an intermediate term perspective, that's pretty promising. And you can see the upturn here in the weekly stochastics as supportive of that potential breakout. And also just the shape of it has that kind of basing phase look to it.
Okay, interesting. Last time you were on, oil shares were an important or mainstay of your ETF. You liked the oils last time we were together. Where do you stand on them now?
Yeah, on crude oil, we did see a breakout, and that was really between June and July, or I guess more accurately, July. We saw a good turnaround there and some follow through that took crude oil above its 200-day moving average. That was in here. Now you see the cloud, it's trending higher on the daily, but arguably not very steep or impressive in the trend. Here's the weekly chart of crude oil. So here too, you almost have sort of a rounded base in place with a breakout of this previous resistance, which was roughly 83. And that to us is roughly initial support now. But this is the hurdle, this $94 per barrel area. Above that, then it starts to look more sustainable. And we've been calling for a potential breakout, but it's looking increasingly less likely with what we're seeing here. You almost see a double top type of setup in the weekly stochastics. So we're not totally convinced that this energy sector relative strength is going to be sustainable. So we're constructive on it in our research. We're overweight We do not have energy exposure right now in the ETF. We have just the leading sectors for, technology, communication services, industrials, and consumer discretionary. Of course, not accidentally very heavy on the mega cap exposure in those sectors, right? So the energy move, we would be taking advantage of it for now, but we would be somewhat non-committal to it.
Okay, where's the bottom of the cloud on WTI?
So here it's around 76. So that would be effectively secondary support. So if you broke the daily cloud, which is a moving target, so it's a little tricky, but let's call this like 82 to 83 if we look at a week or so. You take out the bottom boundary of that. That's going to be a short-term setback that would target the bottom boundary of the weekly cloud. And you can see that sort of 82, 83 area is bolstered by this, which is former resistance.
Yeah. So maybe that's where we have to go to shake out all the people who are long oil because of a potential war and what could happen if it escalates with Iran and the Straits of Hormuz, yada, yada, yada. And maybe they have to be taken out first before we get that move.
It's possible. Yeah, that 76 level is key towards the preservation of this turnaround.
Okay. And I think we've covered the board. Are you doing anything with uranium? That was like Cameco was a huge winner up until a month or so ago. The uranium sector was, I guess, a lot of retail flow. I'm not sure if it was institutional, but they were really strong charts.
Yeah. And listen, we've had a good run in uranium. It was something that I featured a few weeks ago in the media, and they said, well, what are you buying right now? It was like right as the corrective phase and the S&P 500 had gotten started. Right. So I said, well, how about uranium? And if that doesn't tell you how I feel about the equity market, I don't know what does.
Yeah. Did you have a Geiger counter to find the individual issues in uranium?
Well, this is why we went with the ETF. So URNM as a way to proxy for it. And you can see this nice run gave way to a counter trend indication, and that counter trend indication occurred pretty close to long-term resistance. So if I was a long-term sort of interested investor in uranium, I wouldn't worry about the setup. But if I was more of a short-term oriented trader or had just been there for an opportunistic move, I'd probably be reducing.
Okay. You bring up mega cap. Could I ask you to take a look at a couple of them before we say goodbye? Like NVIDIA, to me, looks like it's carving out a right shoulder of a head and shoulders top. What are you seeing there? That's really the poster child for AI.
Yeah, and it's not what it was, right? We know that it's gone from a strong uptrend to now effectively a trading range type of setup. The short-term gauges point higher. You can see it here in part on the weekly stochastic. So we can't be sure that this is a right shoulder, right, until we have some kind of peak. It could certainly unfold that way. What I will say is that, and this goes for a lot of the mega caps and even the major indices, and that's all the more reason to be somewhat non-committal to the relief rally, is that we have counter trend indications on the monthlies to suggest that kind of at best that NVIDIA is probably more range bound for even more than 3 or 4 months potentially. So we have these counter trend indications there. So I think that we can be there short term. It does still have very good relative strength versus the S&P 500, but it's certainly not the position that it was before.
Amazon gave up 15% in 7 trading days, and it's bouncing back. What's the look on Amazon?
Well, it's funny. It really barely participated in the correction. The others, right? And you see that in relative performance here. So this is the ratio. It's a little messy, but versus the S&P 500, just look at that 200-day moving average in yellow. I think that in and of itself is a compelling reason to be long biased with Amazon, just the turnaround in relative performance this year. It shows a growing interest there. And I think you do have some kind of short-term entry. So here's the turnaround versus the cloud, and here's our oversold upturn that's shared by so many stocks. So I think a short-term entry I think that relative performance is really very promising, not just short term, but long term. But it's hardly free and clear of resistance, right? I mean, look at the peaks, right? This is the first hurdles right in here.
So when Microsoft and Apple were making all-time highs, Amazon only retraced 61.8 of its prior decline.
So it's really more of a turnaround play versus those, and you don't want your whole portfolio to be turnaround plays, right? You want to have mostly securities that are in long-term uptrends, and Amazon's not really that right now, but it has some potential, I think.
Katie Stockton, your work is elite, and the way you communicate it is even better.
Thank you so much, Dale. I appreciate that.
Really, you could have great work, but the way you're able to describe it to people really is a talent. So
thank you so much.
We really appreciate you coming here and edifying the F.A.C.E community every time you're here, Katie.
Of course, happy to.
All right. Well, you have a great trading season this fall, and we'll get back together when the snow is falling.
Sounds like a plan. Take care, everyone.
All right, Katie Stockton, follow Katie at Stockton Katie, and check out her ETF. The name of the website before we go, Katie?
We have fairleadfunds.com or fairleadstrategies.com. If you want to research trial, we offer 30-day research trial. So
okay. And the fair lead is an understatement. It should be outstanding lead. So thanks, Katie.
Take care.
All right. So that's a wrap, Warriors. Katie's great, isn't she? I mean, every time I talk to her, you can tell I'm asking her about my book when I'm when I'm interviewing her. Anyway, I hope it adds value to what you're trying to accomplish, bringing top tier technical traders to you. And you could join the team in looks like 19 minutes for the morning edge. Thank you, everyone. Good luck, good hunting, and don't just count your pips, count your blessings. Adios, everyone. Bye-bye.